Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, April 7th, 2020. I just wanted to talk quickly about the new SPY swing trade idea as well as the QQQ trade idea. The stop was hit yesterday at the close. On that, real quickly, bears repeating because I know there's always new members to the site. The trade parameters on a trade. The parameters are the stop. You have usually three parameters on a trade. You have your stop. Sometimes I will list multiple stops, earlier stop based on the earlier targets, but typically the stop is based on the maximum price target, sometimes a second target, or it depends how many targets there are. But you'll always have a maximum stop, price targets, and a suggested position size. It's all explained on the site. For example, if you scroll down here and you see these little dotted lines, see right below there's a dashed line underneath. You hover, that's called a tooltip. It'll tell you, explain that term. A lot of these terms I've made up myself, so that's why I use this explanation. I call beta adjusted position sizing, reducing or increasing above your typical position size based on the volatility of the trade. And of course, you can get more information on that on the FAQ page. A typical position is usually this right here, the SPY, the S&P 500. And so again, there's more on that. And the FAQ page is found here under resources. You click on that, you're going to go into the right side of the chart support center. When you're logged in, you're going to see account settings right here. A lot of things you could do, tools of the trade, very useful stuff. FAQ right there, and you can go in the FAQ page and then further sort by categories, these different questions, membership billing questions, ETF related questions. I can see what are the explanation of how leverage can work for or against you on ETFs and all that good stuff. All right, so back to this trade idea. I want to make mention that number one, it does come right on the heels of the QQQ trade being stopped out, and also in a perfect world, and we don't live in a perfect world, but in a perfect world, I'd like to get trade ideas out there first in the form of what I call a trade setup. And when you come in the trade ideas, there's a category, and you could click on any of these categories, and it'll tell you what a setup is. And I'm kind of doing a little educational bit on the site here because from time to time, I think that's a good idea to do. Trade setups are potential swing trades or longer-term investment candidates that are setting up in a well-defined chart pattern, meaning a bullish or bearish chart pattern. Once the pattern triggers, if and when the pattern triggers, a breakout or breakdown of the pattern, that will become an active trade. So there is a difference between an active trade and a trade setup, and a very important difference. Because a setup might be a stock in let's say, a bullish falling wedge pattern, but then it never breaks out of that pattern. It's in a downtrend. It never breaks out above the downtrend line, and it just keeps going lower. And maybe divergences and other things that were indicating a rally from there never pan out. They don't materialize. So that's the difference. Now, in the case of the trade today, it was an active swing trade, added directly as an active swing trade. And on those, if I see an opportunity, I'll try to get that out. If I add it directly as an active swing trade without first putting it as a setup, and remember, a setup has a predetermined entry point. Might be, when possible, I try to make it above or below a certain price level. Sometimes you'll have a trend line. Gets a little difficult because trend lines, remember, they're upward or downward sloping. So each day they come in at a different price. High uptrend line will come in at a higher price level every day, and a downtrend line comes in a lower. So that's the difference there. Now on this one, when I first put it out there, because we were at that resistance level, I wanted to get it out quickly, and I made a typo, which some other members had pointed out down here. I said objective long. One of the problems is I love going long and short stocks, so it's kind of like my little dyslexia thing here. And what I did is I usually just cut and paste what I put right here onto the post. So that's why if you saw it on the chart, you also saw it on the front page post. But I've since corrected that. Thank you for pointing it out, guys. And as I said in that reply down below, I think I made it pretty clear in the previous post this morning when you look the pre-market comments which way I was going to go there. I mentioned that QQQ was hit, but SPY had hit that final price target. Again, that goes back on this post. If I click on it all the way back here. let's see, and back in mid to March 17th. Those are the price targets for SPY, and they, reiterated all along. And then what happened? Again, it's all in this post. I don't want to revisit something I already covered, but just to kind of touch on it. Remember, QQQ hit. They both had three targets. QQQ hit the final target. That's where we went short, and around that level. And it did have both QQ and SPY pulled back over 7%. At the time, I also mentioned that we'd probably see some chop and slop. I didn't think we'd see the same unidirectional move from this point going forward. Here, I'm in the video, and I know you probably can't see what I'm talking about. And that's what's happened. So now it carried us above my my max bounce target on QQQ. I had that on a different chart. I had right here. It was that one right about this level here was a max bounce target. But what it did, it brought SPY, as I showed you perfectly in the pre-market session today. Here, let me pull a live chart. Forget about these old charts. We were on a 30-minute board right here, and it was right here, T3. Okay, so again, this comes back to this bullish falling wedge pattern here. We were setting up, and then that's where we bottomed. There was our breakout right there. Then we broke out of the more significant primary downtrend line, at least primary on this time frame here, and that was the catalyst for this rally. So I'll make it very clear without mixing words. I think we've come full circle now. That was my uppermost bounce target back then from a few weeks ago. S&P 500's rallied 25%. We all have our own opinions, but I've traded through bull and bear markets in the past. And as I said before we even bottomed, that when we had the next bear market rally, a true bear market rally, this was just a kickback rally, it would convince the masses. You would be second guessing shorting the market, and you'd be wanting to, most people, I'm speaking generally obviously, most people wanting to go long, feeling that the worst is over and it's time to get back long again. So call it contrarian, but I'm not contrarian for the point of being contrarian. The case was being made here that at the very least the risk reward to shorting was no longer favorable. That was made very clear, where there was still a lot of risks in the market. So these were unofficial trade ideas on the way up, but those targets had remained here for the last few weeks, and now they've been hit. And again, that was based on a projection looking out at the charts way back here, as to what a maximum, what I believe to be the upside potential for a bear market rally. And again, that's been hit. So as I said this morning, this is, I believe, one of the best risk-reward ratios that I've ever seen, or that I'm not ever seen, I'm sorry. That's not correct. That I've seen in a long time on the stock market, on the broad market. Now, what does that mean? Well, let's go back and revisit this current trade. Again, this one we're flipped over now. I'm on a 60-minute time frame. There's the parameters of the trade. That's that same T3 level. There's your potential negative divergence, not even confirmed. This is 110% a counter trend trade. We don't have any sell signals at all, such as a bearish reversal candlestick pattern, trend line break, anything else. But there are two ways, or multiple ways, that I will short a stock. And number one would be, let's say, on a break of an uptrend line or a chart pattern. Let's say we had a bearish rising wedge here. And so if we break down below the wedge, that's an objective short. We broke support. Or maybe we break a well-defined price support level. That's also an objective entry. We don't have that here. Sometimes I'll short looking at a bearish candlestick pattern. Maybe we have a candlestick here, we get a big bearish engulfing candle there, and the next day, I know this is sloppy drawing, follow through confirmation after an extended uptrend leading up to that, and I'll use the candlestick sell signal as a short entry. But the other way, and what I like to do in a downtrend, if I believe that we're still in a bear market, which I do, then it's just like in a bull market in reverse. When we're in a bull market, you buy dips, pullbacks to support. So in a bear market or a bearish trend, a rally into resistance is every bit as objective. And the nice thing about that is, again, you can set your stop a little bit above the resistance level. I made mention on the follow-up comments. I wanted to just also talk on that. I did say in that post earlier today, not this, that was this morning's post, which, by the way, I wanted to revisit that because that made my intentions very clear that the next trade on the indexes would be a short. So hopefully, there wasn't a lot of confusion on the fact that I stated that as a long. And again, you can see the arrows and the price targets. So the other thing that I mentioned is I would add some additional text because again, I wanted to get this out quick, and now we have reversed. So sometimes, I've got to get at least the basic trade parameters out to you guys, and again, these emails go right away. I've had quite a bit of inquiries lately because the market's moving fast. People upset that they're not getting these alerts. I use it's the top email marketing provider out there called MailChimp. A lot of huge companies, the S&P 500 companies, a lot of big companies use them. So in other words, those emails are not sent from my server. If they were, they might get snagged in your spam folder, or even your internet service provider like Gmail, Hotmail might filter it out. Because MailChimp is a very well-established marketing provider, they're able to send out bulk emails. I'm speaking technicalities here. If you send out hundreds of emails at one time, if it's not coming from a service like MailChimp, most providers like Gmail, Hotmail, Yahoo, they'll flag that as spam. So by using MailChimp, I'm just telling you this, they're avoiding spam filters. They send out those emails instantaneously. They go out right after, within less than a minute, usually within a few seconds of publishing the post. Where I'm going with this, if you're not getting those emails right after the post is published, it is one of several things. It may be your provider. You might want to contact them. But what I think what it often is if you're using a mail client, that means such as Microsoft Outlook or Thunderbird or the Apple Mail program, whatever Macs have, there are settings in there. Excuse me, a little raspy here today. There are settings in there to how often the mail client like Outlook should check for email. Should it check instantaneously or every few seconds, check for new emails? Should it check every few minutes? Same with your phone. Some phones, if you're using an Android, I imagine Apple's the same way. Is it going to give you a push notification every time? Is it constantly checking for new emails? It uses more battery and more data to do so, but I just want to point that out there. That's where you're getting your emails from. Sometimes the default setting might be check every 15 minutes, check every hour, every half hour, or check when I log on. I just want to let you know that's the best way to make sure you're getting these right away, is to make sure your emails, as an email is sent to you, is it being delivered to your inbox? Because every phone, every computer, the settings are different. So, all right, enough on that. Let's get back to the trade. That's it. Like I said, either works out, doesn't work out, like any other trade. We kept the stops relatively small in the last QQQ trade. This one, they're even much tighter here, and we're going to talk about that real quick. So, from where we shorted, right around that 273.39 level, you're talking a stop of about 2%, and to the final target right now, which very well may be extended if this starts to play out, you're talking a drop of about 10%. So that's about a 5-to-1 risk-reward ratio. This is pretty big resistance up here as well, the 288 level. So I may, depending on what I see today, I'm going to dig through the charts after I finish this video, look at everything. Look at the indexes, all 11 indexes in the S&P 500. I'll look at the top holdings in both S&P 500 and QQQ on the big large cap stocks, and try to determine whether or not to give it a little more room. We may not need it, so let's just see how today goes. I suspect that's it. Again, I suspect that's the end of the run, hence the reason for the tight stop. And so just to wrap up on the technical basis for the trade, you have this potential negative divergence here on the PPO. Potential meaning we need to turn down, and we need to put in a lower peak on the RSI, and that's why I like to wait to see this PPO make a bearish crossover, that blue line come down below the white line there, and that effectively gives you another peak because it's a momentum indicator. It's still pointing higher, and it could burn through the divergences. The RSI has slightly made a higher high, so we don't really have divergence there, but we are at, on this 60-minute chart, you can see this is the most oversold we've been really since the entire bear market started. Here was all-time highs there. And the other thing to note too is look where we rallied to. We put up a Fibonacci retracement right here, covered these the other day. just yesterday. In fact, we were at the 38.2% retracement, and now we rallied up. I think maybe it's in QQQ. Yeah, SPY is almost to the 50%, and I think QQQ is right there. Let me remove this line here and show you that on QQQ. Okay, QQQ, got fibs here, there it is, right there, smack into the 50% Fibonacci retracement level. Again, just a level traders watch out after we had a failure here on the first two hits of the 38.2. So we have both price resistance and Fibonacci retracement level. And additionally, because QQQ is a major large cap index, you had that 203.29 level, pretty significant resistance as well in QQQ. So it's both price and Fibonacci resistance on the Qs right there. And so that's pretty much it. Let me just digress real quick fundamentally. Tell you what I think's going on, right or wrong. My opinion, is maybe proven wrong, but what I suspect this rally is, and what's carried us this extra lift here, where I thought that would be it when we hit the final target on QQQ and SPY at the same time. Remember, QQQ hit the third target, hit it here, hit it again there, and fell, and then SPY, if you remember, at the same time hit T2 and again, these were T2 levels given back here at the lows. T1, T2 hit twice, fell back. What I think is happening here is there's still a lot of short interest. There's still a lot of very high put call ratio. It's not at extremes anymore, but it takes a while when you hit those extremes for it to be unwound. It doesn't get unwound in one day. So I think yesterday was a combination. I think it was no doubt a lot of shorts were squeezed out. So I think it was a lot of short covering, and believe it was a rally solely because I've been scouring the headlines more than I usually do. I usually put my primary focus on the technicals, but right now I think the fundamentals are every bit, if not more important, and everybody's watching coronavirus. So here's what's happened. There's been all these predictions that started coming out over the weekend, a little before that, about peak. We're going to see a peak here and everything's going to moderate. Well, so the market's rallying on that, and I've already made my thoughts very clear, and I'll just reiterate it, that I think the damage is already done, period. Coronavirus, and it's not going to happen, but it could literally disappear today, and I do believe that the market will not take out the previous all-time highs. I think too much damage has been done. I think the supply chains have been disrupted. Consumer confidence. Remember, guys, consumer spending is 70% of GDP. 70%, over 2/3 of gross domestic product, is attributed to consumer spending. We've seen a surge in unemployment like we've never seen. We've seen a recession that happened almost overnight, and there's going to be huge, longer-term implications here. I feel very strong on that. So now, coronavirus it's not going to go away right away. A few weeks back I mentioned, when I'd first heard about not just that malaria drug, the chloro something or another, hydrochloro something, but along with the antibiotic was showing very promising results, a combination drug. And I said, look, before we have a vaccine, because everyone, all the smartest people tell us that's at least a year out, there's a good chance we'll have some type of something that helps with the with the coronavirus, even if it doesn't stop at cold in its tracks. Something akin maybe to Tamiflu, where it reduces symptoms, makes people not as contagious, helps prevent people from getting to that critical stage. And look, I still think that comes, but you know what? It's probably not here yet, because with yesterday's rally, I start to wonder, okay, this is a strong rally. Maybe the smartest of smart people are up there rubbing elbows in Washington and Wall Street together. The big pharmaceutical companies, the CEOs, they know what's going on before we do. That I can tell you. If there was some type of very promising drug combination in trials right now that had a super high cure rate, what I've heard early on was that combination therapy that I mentioned before with the antibiotic and the anti-malarial drug was showing almost 100% effectiveness. Now, the sample study was too small. where I'm going to go with this is I don't think we're there yet. I don't think that's it. Why? Well, I don't think the leader of one of the G7, countries, would be had in ICU right now. What was it? I think it was about 2 weeks ago or so, if I recall, when British Prime Minister Boris Johnson, they announced that he had coronavirus and he was at home monitoring and all that. And then, of course, yesterday the news was he was moved to ICU. Things aren't good when they put you in ICU. And here's my thing: I have to imagine, as the leader of one of the world's largest economies, he had one of the best doctors on hand throughout this whole thing monitoring. And I have to imagine too, if there was any type of effective therapy out there, it would be known and would be given to the British Prime Minister, and he would not be in ICU today. So maybe that's just, maybe I'm wrong on that, but I'm just saying that's showing me that I think there's a little hopium in this rally right now, and that look, even if with all this social distancing, we start to see, things do peak, at least in some of the big cities like New York and all that. Well, guess what? That's because of the social distancing. Now, what happens because we peaked? Everyone starts going back to work again, starts shopping, jumping on planes, taking cruise ships, and there's no fix for this. We're going to be right back to where it started. So there's no solutions here. So any abatement right now in the number of cases or any peak, you can keep it at that if you keep the social distancing, if you keep businesses shut down. Anyways, I fundamentally at this point in time, short of them coming out with something that pretty much stops this thing in its tracks or puts a major dent in it, and then gives people the confidence that they can go back to work, and the government has the confidence that they're not going to spread this and have another flare up. No. And what'll happen after a bear market rally, if that's what this is, and I'm not a fearmonger, but if what usually happens in a bear market after the first bear market rally, hold on and strap in, because we could revisit that selling even worse. You take a step back and look at just what's happened since the top right here, and again, sometimes I'll make mention to Elliott wave theory, which on a primary 5-wave down, you have your first wave down, second kickback rally, and wave 3 is the most powerful wave. I like to think that's not coming, because the market's already suffered so much damage in short order that if that happens, as I already said before, the financial system will break. It was on the verge of breaking back here. I talked about that here coming down, and then at this point you started reading about it. Money market funds had to be shored up by the Fed, the repo market, just about everything. The banks had to be shored up, even the consumer businesses. So ugly stuff, and I hope it doesn't happen. And right now, maybe what I said a couple weeks ago, that after this point here, maybe we just continue to chop around for a little bit. That's actually what I'm hoping for. This would be very profitable to swing short down like this, especially a waterfall move, but I don't want that. I'll take it if it comes. I'm going to play the market. Market doesn't give you what you want, but right now I'm fine with taking this, because there's plenty of money to be made on a short trade that plays out somewhere along these lines right here to these targets. Again, we're looking at from T3, the final target right now, 10%. So let's just assess things as they come. Maybe we get stopped out. Maybe I've spent the last 20 minutes talking for nothing. Market blows on up through here, takes out that level, and keeps going. And if that's the case, then hopefully some of our other trades, our ag commodities, our gold, and other things that we're short on or long will pan out. LQD, I still like this one. I don't want to get off task. I want to get back to SPY here and show you a couple other things. Okay, the other things I wanted to show you are the, although the price targets were in the chart, I wanted to get that out, and I got out the suggested beta adjusted position size, which I'll talk on in a second. I added a few more notes here, and also gave you some alternatives for those of you that aren't able to short because you don't have a margin account, or maybe you want to hedge or go pure play short in one of your retirement accounts. Then here are your short ETFs. SH uses it's inverse, no leverage, just a one-time inverse. If the S&P 500 goes down 10%, this one will go up 10%, give or take. Then you have SDS, leverage up 2 times inverse, and then SPXS, 3 times inverse. As I mentioned, you might not want to go with the 3 times. You could certainly start out right now. We've had some stability in the markets, volatility's low, but if we happen to get into another one of those waterfall type sell-offs like we were in just a month ago, then you probably be best off tempering down that leverage to either SDS or SH right there, or a pure play short. That's always your best bet. And again, if you don't use futures, you can certainly trade the futures ES or MES, which are the micro E-minis, if you don't have enough for the ES contract. But you do like the fact that futures, I love futures because they're trading around the clock. You can get in and out. You can control your stops overnight. When you have those big 5+% moves up or down in the futures overnight, in SPY or any of these ETFs, you're at the mercy of a large gap against your position where you can control that using ES or MES. Again, I don't have a drawing tool here, so I'm just using a line tool, but those are your two. And this one just has smaller leverage factor, trades on the same levels as ES does, same price levels. Okay, and then finally, just a little, little suggestion, if you will, on position sizing and how to trade a bear market. Like I've talked about for weeks now, volatility is for the time being here to stay. So yesterday, as I said, 7% rally. What's any different than a few weeks ago we were having 7+% drops in the market? So it's par for the course to see these 5% daily price swings, even 7, and we've seen swings 10% or more. We've had the circuit breakers hit a couple times where the S&P 500 dropped over 10%. So it's just the nature of a bear market. The rips are just as powerful or nearly as powerful as the dips. And again, unless anything technically significant changes, don't read too much into a big drop or a big rally when you're in a bear market. Again, if something technically significant changes, such as a breakout or a breakdown, that's when it means something. Okay, so yesterday was just a rally within a bear market that took us with an overnight futures rally right into resistance today. Now, where I wanted to go with that is talk a little bit about the position sizes and everything else, and we'll wrap it up there. So if you go into, on the top menu of the site, you have a couple things here right next to your account settings page icon. You click on that. You have the position size calculator. So if you click on that calculator icon, it's going to give you the position size. So I always try to lay out suggested beta adjusted position size, and so if you're using this one to figure out, okay, how much do I want to put at risk in QQQ? Well, start out with, what do you typically trade? SPY is the broad market, the S&P 500, so usually a beta adjustment's based around that. So we're going to use this trade. So let's say you normally trade $10,000 in a position in a SPY or Apple or Amazon or something along those lines, large cap stocks that don't have a tremendous amount of risk, but yet move up and down with the market. Okay, so the beta adjustment for this trade was 1.0, but let's say you wanted to go with SDS. So SDS, because it's 2-time leverage, you would use a half position size or a beta adjustment of 0.5, right? So that then tells you that in that case you would take a position size of $5,000. And so this is a short trade, so let's plug in the parameters here. So the entry on this trade was posted at 273.17. I'm looking at another page here, another monitor. Let's say you're targeting the third price target, which is the current final price target. That's 245.37. The stop on this trade. Now, given it's a daily close, so we don't know exactly where that'll be, but let's just say we'll use that number right there. Say we close right on 279.09. That gives you a very attractive risk reward, an extremely attractive risk reward of 4.7 to 1, meaning for every dollar that you're risking to lose if you're stopped out, you're attempting to make $4.70 in profits. That's how that works. And it'll also tell you, give you the number of shares based on the entry price. Now, I did this a little different. That was, I didn't use SDS there. That was on SPY. So if we use SPY because it was a 1.0, let me go back to that. It's going to tell you to short 37 shares of SPY in order to give yourself that $10,000 position size, and it'll tell you, and then in actual dollar terms, what you're going to make or lose. So if we hit that final target, you're going to make 10.2%, which is $1,018 in profit. And if you're stopped out, you're going to lose 2.2% or 217. So this is big, and I think the a lot of people focus on this, how much they look at dollar signs and what they can make. But you also always need to pay attention to this number here, and put it, and it gives it in hard dollar. Are you going to be okay with a $270 loss? If not, you have two choices. Either take your position size down, use a lower stop, or pass on the trade. Of course, you can do the same thing here for your total account if you want to know how much you're putting at risk here. If you have a $100,000 portfolio and you want to risk, let's say, 2% of your portfolio on a trade, it's a short trade, same thing. You can plug in all the parameters here, entry price, all that good stuff, and it'll tell you how much total is at risk there. So take advantage of these. I spent a long time building these, so I think they're very useful tools. And one day, time permitting, I want to put one in here for futures, and that'll be, I think, kind of neat. It'll show you, because futures have a very high leverage factor. You'll be able to put that in there and do the same thing and see how much it is at risk if you're trading futures. And that's it, guys. I know I gave you a lot of fundamental ramblings there, but I think that's important stuff. I do. I believe it's important, and it shares my mindset as to why, at this point in time, nothing, my outlook has changed. In fact, if I liked, shorting QQQ back here in the market, SPY, which I did both, then I love it up here. Let me just say that I think this is a even better price. The fact that we've gotten to this level here, and again, the RR is a little bit better here now because you have more downside potential. And depending on how this starts to pan out, if it does, so far a nice reversal, nothing to really write home about yet, but big old gap to be backfilled, first target there. These are the actual support levels. You can see I set these just above. These are adjusted since it's an official trade. These are the adjusted targets. And let's just wrap it up here and see how we close today and what happens the rest of this week. This has been Randy Finney with Right Side of the Chart. Best of luck on your trades.